we need to do is take a look at these markets from a fundamental and technical perspective, and we're going to bring in the experts to do it. We've got Larry Shover. He's SFG's Alternatives Chief Investment Officer, and on the fundamentals, we've got our guest host for the day, Michael Gapin, head of Barclays Asset Allocation. Michael, I'm going to start with you. Barclays has their 2013 outlook penned, ready, published. Where do investors want to be?
Well, we still think that over time investors will be rewarded taking on risk in the equity space and in corporate high yield. We just think the alternative low yields on investment grade and sovereign bonds are going to gradually move investors over into the equity space. So I hear what you're saying on some softness in the U.S. Obviously, the CPI numbers today are consistent with a relatively slow growing economy. Risks remain somewhat elevated ahead of the fiscal cliff, but we would say looking forward over time, this might be a time to take on some of those softer cyclicals, take on some of those falling in price technology stocks. On the other half of a fiscal cliff, growth in the U.S. still looks good on a relative basis, and we should start to get some pickup in earnings growth sequentially. But obviously right now, ahead of the cliff, in a slow growth environment, stocks in the U.S. are struggling, a bit in contrast with stocks globally, however.
Michael, before we bring in Larry and get his take on the trading side, I'm just curious to explore for a moment. In your 2013 outlook, you say this next year is going to be a tale of two halves, and the second half will be a lot better. Why does it necessarily get better in the second half? What are you keying off?
I think what we're saying there is obviously ahead of something like the fiscal cliff. There's a high degree of consensus about the outcome of the cliff, meaning we'll reach a resolution before a significant disruption to markets occurs. On the other side of that, you're just saying that, okay, we've resolved a bit of uncertainty. The corporate sector has withheld a lot of investment and potentially some hiring as it waits for a resolution to these issues. So we would expect the second half of the year to look better as some of that pent-up demand and activity takes place. Right now, we think it's sitting on the sidelines and could gradually come in the second half of the year.
But as these corporates face inflation concerns, couldn't we see them sit on their hands even longer, so we might not get that in the second half of next year?
That's right. So I'm not suggesting it's going to be a big bang kind of result. We tend to think it's going to be more like a grind, that you resolve a point of uncertainty and gradually the corporate sector begins to put in place some of those investment activities. But I would not look for a big swing in sentiment. Just the more points of uncertainty we can resolve, the outlook starts to look a little bit better. At the absolute level of growth in the U.S. is not phenomenal, but on a relative basis, it's still good. And then we think that after the end of the first quarter, the downward earnings revisions will likely be out. So some of the retail stocks that we think earnings still have to come down in that sector, consistent with what Adam was saying today, we think that will have played itself out. So we just think sequentially the second half would look better than the first.
Larry Shover, you've just gotten a front row seat to the world according to Barclays' Michael Gapin for 2013. What's your take?
Well, I read half of his take last night, so I'm a little bit bullish, a little bit more bullish than Barclays or Michael is right now. The market's really tired. It's fatigued over the FOMC, over the Fed. Once that gets out of the way, which I know it will be, we'll return to a multiples market. Keep in mind, back in September, we were willing to pay 14 times earnings, which gets the S&P up around 1,500. So right now, it's muddle, trouble, and maybe just a little bit of toil. But I think we're going to end the year up around 1450, 1475. No question in my mind, next year 1550 as we return back to a multiples market.
Michael, the biggest headwind we face, if you had to pick one.
The biggest headwind in the U.S. is the cliff. I mean, I know it gets repeated every day, and I would just agree with what Larry said. And in fact, we remain overweight U.S. equities. We remain overweight the U.K. We are overweight Europe. We think that there'll be a gradual grind out into risk assets. The risk-return profile in equities looks much better. Our year-end targets for the markets in the U.S. are similar to what Larry said.
Hey, Larry, but before we let you go, your trade for the last few weeks of this year to try to incorporate some of what we're talking about for next year?
Yeah, absolutely. I think I would buy something in a beta chase, like a Boeing, a Halliburton, Occidental. And then if you want to go against that, buy an out-of-the-money call spread in the VIX just to protect yourself. The VIX right now is in the 38th percentile. It's not cheap, but it's right there. So that's a great way to hedge yourself. But I would buy a beta chase, and that's what we're going to see pretty soon.
Well, thank you both for your thoughts today. Larry Shover, SFG Alternatives CIO, and Michael Gapin, Barclays Asset Allocation Strategist, will be with us for the hour.